Utilities are built for stability, but that covered calls, and suddenly things get rather exciting. Today, we're testing the top covered call utility ETFs to see who comes out on top. Hold on to your seatbelts, folks. This is going to be a shocking one. Utilities are one of the most defensive sectors in the market. They keep the lights on, the heat running, and of course, more importantly, they keep those dividends flowing. That's why investors turn to them for stability, especially during uncertain times. But today, we're not just talking about plain utilities. We're going to pit two Canadian covered call ETFs, Hamilton's UMAX and Evolve's UTES, head to head with iShares XUT acting, that's going to act as our benchmark for the sector. If you're new to the idea of covered calls, here's the quick version. It's an option strategy where the ETF sells call options on the stocks it already owns. The trade-off is quite simple. You collect extra income from option premiums, but in return for that, you are giving up some of the upside, if, of course, those stocks decide to go on a run to the upside. For that reason, we're not just comparing UMAX and UTES against each other. We're also stacking them against XUT, a straight utility ETF with none of those fancy frills. So no covered calls, no leverage, just vanilla. That way, as kind of a bonus piece of data, we can see exactly how much upside you give up when you add covered calls and whether that extra income is worth it. And for investors who are more focused on total return rather than pure income, this benchmark will give you a lot to think about for sure. A sub to the channel is the best way to capture upside in future content. Now, UTES was only launched in September of 2024. So for today's battle, we'll be focusing on that 1-year time frame. But I do want to point out a major consideration here. The Bank of Canada began cutting rates in June of 2024, and that gave utilities quite a bump up through the summer. By September, utilities were peaking, and that is going to skew some of our total returns down quite a bit. Without any further ado, let's do this. We will begin with the Hamilton Utilities Yield Maximizer ETF with a ticker of UMAX, so UMAX. This ETF will give you exposure to both Canadian and US utilities, as well as some telecom and transportation stocks. It then applies an active covered call strategy to provide that much loved additional income for sure. On average, they typically write on up to 50% of their holdings. Looking at their top 3 holdings, we've got Emera, Brookfield Infrastructure, and Fortis. At the time of recording, their current value coming in at $13.50, not that far off of their NAV, which is sitting at $13.51, and their assets under management, $830.05 million. In fact, I think this one takes the cake on the assets under management. Switching over to fees, they have a management fee of 0.65%, and that works out to a management expense ratio of 0.85%. Let's take a look at that dividend. They have a yield of 14.44%. It is a monthly dividend of 16.15 cents per share. And when we take a look at their return on investment, as I mentioned before, we're dealing with the 1-year frame. That's all we have. That comes in at negative 10.75%. But, of course, once you factor in those dividends, we're back in the positive 1.39%. And this is a new statistic for us. What if they reinvested those dividends? So their reinvested total return, that goes up a little bit, 3.80%. Remember how I mentioned that 1-year frame was skewered lower? Oh boy, can you really see that here? These numbers should be much better than this, absolutely. Okay. Let's see how our next ETF fares. And of course, our next ETF is the Evolve Canadian Utilities Enhanced Yield ETF, ticker of UTES. This ETF is less broad in scope, as it provides exposure simply to Canada's top 10 utility companies. It also uses a covered call strategy, and this one throws in a wee bit of leverage, 25%, to really help bolster their potential returns. Their top 3 holdings include Rogers Communication, TC Energy, and Pamina Pipelines. I've never really viewed Rogers as a utility company, but yeah, they're in there. At the time of recording, their current value $9.40, and once again, pretty close to their NAV, which is sitting at $9.42. Assets under management, it is lower, 143.04 million. Looking at their management expense ratio, that's coming in at 0.84%. Looking at their dividend, oh boy, this is a good looking yield, 17.58%. Monthly dividend of 13.8 cents per share. All right, let's switch to the returns for that 1 year. Return on investment, negative 8.29%. Once, of course, we factor in those dividends, we get a total return of 7.86%. And if we reinvest those dividends, that total return jumps up to 9.56%. And these numbers are also, of course, skewed lower, but between UMAX and UTES, now, I do think we have a clear winner over that 1 year time frame. Before I talk about the results, let's take a look at that benchmark. And we're talking about the iShares S&P TSX Capped Utilities Index, ticker of XUT. So this is our no frills utility holding ETF benchmark. They hold 14 Canadian utility companies and as I said, no covered calls, no leverage. Looking at their holdings, their top 3 holdings include Fortis, Brookfield Infrastructure, and Emera. So at the time of recording, their current value, $30.44, and they have an NAV of $30.42. Those assets under management, 312.27 million. Okay, their management expense ratio, of course, much lower than the other two, 0.61%. And their yield is significantly lower, 3.86%. That is a monthly dividend of 10 cents per share. All right, now let's take a look at their returns. So on their 1 year return on investment, that is in the positive. It's 7.60%. Factoring in the dividends, we get a total return of 13.45%. And yes, we will do it here as well. If we reinvest those dividends, we get a reinvested dividend total return of 16.39%. These numbers are very interesting. I think I want to jump into the results and see exactly where that leaves us. All right, let's hand out some wins. First up, when it comes to income, UMAX is throwing off a huge 14% yield, but well, UTES takes it even higher with a monster 17.5% payout if all you care about is monthly cash flow hitting your account. UTES is your clear winner here, no questions asked. But when we shift over to total return, the story completely flips, of course. Remember how those covered calls cap your upside? Well, XUT, our plain no frills benchmark, just crushed both of them, posting over 13% total return, while the covered call ETF struggled to keep up. Sometimes boring really does win. Of course, if we now look at it from a reinvestment standpoint, factoring in those dividends, reinvesting them, we still get the exact same picture. Even though UMAX and UTES are spitting out big yields, XUT still comes out ahead when you let those dividends compound. Although the covered calls do eat into their lead quite a bit. Not enough, though. So here's how I call it. If you're hunting for income right now, UTES is a cash machine. Simple as that. If you want steady growth and compounding, XUT wins the crown. And what about UMAX? They are your balanced middle ground. Broader diversification, active calls, and still a healthy yield without the leverage kicker that UTES brings. So at the end of the day, there really isn't one single winner. It comes down to what you want as an investor, because between the 3 of them, if you're after big monthly income and don't mind some extra risk, UTES is your heavyweight champion. If you'd rather stick with steady long-term growth and let compounding do the heavy lifting, then boring old XUT is the clear choice. And finally, if you're looking for a bit of a middle ground, decent yield, broader diversification, and active management, then UMAX might be the one that fits your portfolio. That's the beauty of this showdown. The numbers tell us that covered calls aren't always about beating the benchmark. They're about tailoring income and risk to match your goals. If you are interested in the ETFs that we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on building a $100,000 growth income portfolio. Thank you for watching, and I will see you in the next video.